Mikkel, on a serious note, when we're talking about spending related to warfare here, of course, on a nominal basis, the US is the largest contributor to the Ukrainian side of the equation, while we have less on an aggregate basis stemming from the EU, basically. A country like Denmark, where we're situated, you're listening to Macro Sunday, hosted by Andreas Steno. Hi, everyone, and welcome to this edition of Macro Sunday. My name is Andreas Steno. I'm the founder and CEO of Steno Research, and each and every Sunday we provide you with the hottest takes on global geopolitics and macro in this weekly podcast. And also towards the end, an actionable section on how to trade it. Mikkel Rosenvold, welcome to you.
Thanks a lot.
You're my partner here at Steno Research. You're in charge of our geopolitical offering, and we have plenty to discuss around Ukraine-Russia this week, alongside a discussion on the melt-up ongoing in financial assets. Oh boy, we've seen a cyclical repricing right, left, and center across assets this week, and it rhymes very, very well with how we've restructured the portfolio over the past weeks. So in that sense, the mood is pretty decent this week, Mikkel.
Absolutely.
Remember that we've launched a free newsletter. If you want a few macro nuggets a week, access to free slide decks, free videos from Steno Research, please sign up. We have left the link to the free newsletter in the description of the podcast in case you're interested. Mikkel, I guess Nvidia has sort of been the center of attention last week. The AI wave is, to say the least, still ongoing, and Nvidia surprised everyone to the upside once again. What do you make of that AI wave, and whether it's got legs here?
It's obviously got legs, and it's the potential is just mind blowing, and that's of course what we're seeing in the Nvidia stock. I mean, this is of course a very solid annual report, but remember that all these growth expectations comes at a time where a lot of other companies are looking to get into the chips market as well, and despite of that, there's still huge confidence in Nvidia, and rightly so, in my opinion. This market is going to grow exponentially for the coming years, and that's of course what's layered into the cost of Nvidia right now.
Yeah, and Mikkel, we've had plenty of questions, both from hedge funds, asset managers, and so on and so forth over the past week around the client base of Nvidia. Who the hell are buying all of these GPUs?
Yeah.
And I guess the short answer is Microsoft and
Amazon. Very much so.
Yeah.
Google, yeah. All the big players are buying their stuff. All the big players, I suppose, have plans. We've heard about some of them, OpenAI, etc., have plans to produce this on their own. But there is a very long prospect for them to get their own supply chains up, or separate supply chains. So for right now, Nvidia owns this market and are going to for the next couple of years.
Yeah, it's as simple as that, basically. So is this cyclicality in the Nvidia stock and in the demand for GPUs a sign of an improving global economy? That's really a key question right now, because if you look at the global trade of semiconductors, for example, basically a gauge of the demand for AI, you could argue, those measures are absolutely through the roof. We're talking about increases, for example, in Taiwanese and Korean exports of semis of, say, 75% to 100% on a year. But is this a symptom of a broader pickup? That's kind of where markets are leaning right now, but it's not given yet.
No. Within these sectors, absolutely. Is it a sign of a broader pickup? I'm not too sure of that. What we're seeing right now in some countries, especially the US and China, is the semiconductors have been put into the strategic element or the strategic group of commodities, basically, of goods. And that means that while oil is becoming less of a strategic commodity, especially for the US is emptying their oil stocks, basically. They're beginning to stock up on semiconductors, and that's part of what we're seeing. We've never seen that before. People would usually buy semiconductors and use them right away, because if you kept them in a warehouse for a year and a half, they would be outdated. That's still the case, but people are still, but the US is beginning to view this as a strategic resource, and thus beginning to think about stockpiling these semiconductors for military use, etc. That's also what's driving up prices, and that's very much an isolated issue, I believe.
Yeah. There are, I'd say, a few signs of a broader pickup outside of semis and AI-related stocks right now. We've had the PMIs and the IFO survey out from Europe over the past week. Kind of a mixed bag of goodies, but I think it's relatively safe to say here that the bleeding has stopped. We see progress in France for the first time in a while. And the cocktail in both the French and the US PMI was actually pretty decent when you look at it from a business outlook relative to a price outlook perspective. Input prices are down on everything related to the production of goods, while the business outlook is improving, albeit from weak levels, but it's improving. And it's essentially why we've taken a decision to tilt everything in a pro-cyclical direction in our portfolio. So far, with great timing and great luck, we've conducted a study on how to trade the cycle across assets. We've looked at how various asset classes price in the business cycle, so everything related to manufacturing. And we find that cyclical FX pairs look cheap. We find that many commodities look cheap. And we find that equities related to the cyclical part of the economy, so basically the manufacturing of goods, look cheap. If you want to see the entire study, you can either find it on stenoresearch.com or sign up to our free newsletter, and we'll provide you with this slide deck on the beta studies across asset classes on assets that look cheap relative to the business cycle here, because as far as we can judge forward-looking indicators, they're improving, also outside of AI. But Mikkel, the situation for the Ukrainians is not improving. We've heard stories over the past week of Russia making progress. I even saw, I think it was in Wall Street Journal, an article suggesting that Russia could march towards Kiev again. Do you buy into that notion, or where do we stand right now?
No. I mean, right now Russia has the initiative. They had so last winter as well, and it's emphasized, of course, by the upcoming election in Russia. We can get back to that a little bit. There's no doubt that Ukraine has lost the initiative. They've lost the ability to carry out major offensive operations, mainly because the Russians are too well dug in along the front line. They are relatively well equipped. They are able to replace the losses, and they're able to keep up high levels of losses. And that means that Russia can keep, and this may sound cynical, but Russia can keep investing 20,000 casualties a month into into operations, and that is basically the calculus that they're doing right now. Ukraine had the strategy for most of 2023 to bleed out the Russians, to let the Russian take so many casualties that at one point the Russian electorate would or the Russian elites probably would grow tired of this. But Putin and his system has managed somehow to keep replacing all these losses. Losses are in excess of 350,000 over the course of the war. At least 150,000 dead of those. No other country on earth, perhaps India and China, they haven't really been put to the test on that. But no other country on earth could stomach such losses but Russia. And that leaves Russia in quite a good position because they have strategic patience. They're okay with how things are at the moment because they're basically keeping Ukraine in a deadlock. Their economy is, depending on how you look at it, doing okay. You shouldn't put too much value into GDP growth over there, because the GDP growth is basically spent on missiles that they're burning in Ukraine. So it's not really making anyone richer.
No.
But still, and most of the GDP growth, of course, comes from government borrowing. But they don't have too much government debt. They can keep borrowing in China if they want. So Russia is set for a long war. They have the men, the weapons, the money to keep a long war going, at least until Vladimir Putin dies. And that leads me to sort of the only two people who can right now force Vladimir Putin or force Russia to the negotiating table. It's two people. It's God and it's Xi Jinping. That's basically what we're looking at right now. And that's also why, I mean, in the West, there's a lot of debate about should we try and negotiate. I don't think Putin wants to negotiate. Why should he? He's in a very good position. This allows him to strengthen his grip on the Russian society. Why should he negotiate right now? The support for Ukraine, we can maybe talk a little bit more about that. It's still it still looks very difficult in the U.S. to keep up support for Ukraine, and even if Biden and Congress is able to pass one bill, that's probably going to be the last major bill for Ukraine, especially if Trump wins the presidency. So we are looking at a rather bleak picture for Ukraine regarding U.S. support. The EU support is still there. EU is still investing, especially our home country, Denmark, is still investing heavily in Ukraine. And I think it's dawning on European nations that they have to take responsibility for the Ukraine war, basically. The thing is, though, even if EU can supply all the munitions and all the weapons and all the money that Ukraine needs, at some point Ukraine is going to run out of men. And the EU is not willing to provide EU with men or women, for that matter, to throw into the meat grinder. And that is the strategic dilemma for the EU, even if we can prolong the war for a couple of years. So right now, it's a huge strategic dilemma for the West. I don't think Russia's going to be marching into Kiev anytime soon. I don't think Russia's trying to force anything here. They're slowly building up their initiative. Ukraine may go on the offensive this summer, but Russia's well prepared to push them back, basically. So right now, not a very good picture.
And Mikkel, when you refer to God as one of the two people able to bring Putin to the negotiations table, I suppose that you mean Donald Trump. So as per usual, we have a soundbite from Donald Trump. And the soundbite this week is from Donald's visit to Saudi Arabia a few years back. I don't know whether Donald was there as the President of the United States or as a snake oil salesman. But here is Donald trying to pitch a few ideas to Mohammed bin Salman of Saudi Arabia.
But if you look in terms of dollars, $3 billion, $533 million, $525 million, that's peanuts for you.
And for those of you not watching the show here, Donald Trump is sitting with a couple of pictures of American
fighter jets,
and saying that's peanuts to you, Mohammed, and I love it. Mikkel, on a serious note, when we're talking about spending related to warfare here, of course, on a nominal basis, the US is the largest contributor to the Ukrainian side of the equation, while we have less on an aggregate basis stemming from the EU, basically. A country like Denmark, where we're situated, on a per capita basis, we're paying way more than the US, but still, like, if you aggregate it all, the US is obviously the main contributor here. So this guy trying to sell air fighters to the Saudi Arabian administration here, he's typically in favor of asking countries to pay for it instead of the other way around. So, I mean, what if the US administration pulls the rug from under Ukraine here once Donald is back? That's basically the base case for bookmakers, right?
Absolutely. They can pull the rug in two ways. First of all, financial and with regards to the support for Ukraine, I think the EU will and can, perhaps not easily, but relatively easily replace that. It's a matter of will, and the will is there in the EU at the moment. The the main issue for EU for the European Union in that regard is simply the lack of production capacity, because as this clip shows us, we're used to buying all the stuff in the US or a lot of our weapons, and right now the EU is trying to scramble to increase the production capacity of military goods within Europe. Basic rearmament strategy. Right now, EU is being outproduced by North Korea, as we've mentioned before here. So that's the next step. And I mean, how's that going to sit with Donald Trump? I mean, he wants us to spend more on the military because he believes we're going to buy stuff from Northrop Grumman and Boeing and what have you. But if we produce ourselves here in Europe, how does that leave the US? So I'm not too worried about the US support slipping away. The EU will, to some extent, replace this. The political support is more critical for Ukraine, because I don't think Ukraine trusts European support enough to keep the war going. So if Donald Trump calls Zelensky and says, "I'm out of this, you have to sue for peace," Zelensky has to do something about that. He can't simply rely on the EU on the grander political scheme of things, because the EU has no leverage over China. Donald Trump is the only one who can call Xi Jinping and maybe get some sort of deal done.
Yeah. And Mikkel, the cocktail of rising cyclicality in the global economy, rate cuts in China, we haven't mentioned those yet this week, substantial rate cuts, that is, and this continued turbulence around geopolitics and the ramifications for the global financial system. That trio of themes spills directly into the crypto and digital asset market. We've seen positivity in that market after the rate cuts in China, typically a sign of capital outflows. We've seen positivity in that market around the warfare in Ukraine, Russia, because it is kind of a proxy way to trade things across borders. And we've also seen positivity in that market due to the rising cyclicality in the global economy. So I think it's time to invite our colleague and our head of cryptocurrencies, Mads Eberhardt, to the studio. Mads wanted us to introduce him with the song from Zombie Nation called Kernkraft 400. Here it is. See? Mads Eberhardt in the studio. Mads, great to see you.
Thank you. You too.
And Mads, it's been quite the interesting year so far for the crypto space. Tremendous returns, more or less, across the board.
For sure.
If you look at the trend in Bitcoin relative to other cryptos so far this year, what are sort of the main takeaways right now in the crypto market?
I think the main takeaway is that, for sure, we got the Bitcoin spot ETF back in the beginning of January. And actually what we have seen so far for the past month or so is that actually the net inflow into these ETFs are much bigger than what we expected. So for sure we had the first couple of weeks where the market was disappointed by the net inflow, especially because quite some outflow from the Grayscale Bitcoin Trust ETF. But then afterwards, when that outflow cooled down, we actually saw that especially BlackRock's spot ETF and also Fidelity's spot ETF, both of those have seen quite some inflow in the past few weeks. So it has pretty much been Bitcoin being in charge of the market this year so far. But also the market is also starting to anticipate the Ethereum spot ETF, which we expect with a high likelihood will launch in May this year.
Yeah. And if we look at the price patterns in Ethereum versus Bitcoin, we've actually seen Ethereum outpacing Bitcoin basically since we launched our portfolio.
Yes.
And you have an overweight on Ethereum relative to Bitcoin. Is that based on the hopes of the Ethereum spot ETF, or is it also grounded in fundamentals?
So it is actually mostly grounded in fundamentals. Of course, we expect that we will see this ETF, which is pretty vital to be able to outperform Bitcoin, because Bitcoin's ETFs, they see so much inflow. So that's pretty vital. But not least, it is about the fundamentals. So instead of having an inflation, then then Ethereum is pretty much deflationary. You have much higher demand for doing transactions on the network, and not least also you have this narrative around these layer 2s, also known as roll-ups, which is about to scale Ethereum massively.
So, Mads, when we talk about layer 2s or roll-ups, I think for the sake of our audience, we need to sort of define the difference between layer 1 and layer 2 here.
Yes.
So what's the main difference between a layer 1 and a layer 2 token?
Yeah. So basically what Bitcoin and Ethereum both are, they are what we call as a layer 1. So they are the main blockchain itself. It is basically a blockchain. They don't settle their transactions to any other blockchain. What a layer 2 basically does is that, at least on Ethereum, they take a lot of transactions on their own blockchain. Then they combine them. Then they make a batch out of those transactions, and then they settle one transaction down on Ethereum. So even though that one transaction on the Ethereum network is pretty gas heavy, meaning that it's a pretty big transaction, then it maybe consists of 500 transactions or 1,000 transactions on the layer 2, making them much cheaper.
And Mads, when we talk about scalability in relation to transactions, these roll-ups or layer 2s, are they necessary to actually bring about the scalability needed for future transaction levels, for example, on Ether?
Yeah, that really depends on who you ask. So the scalability approach that Ethereum has is around what we call off-chain scaling. So meaning that it relies heavily on layer 2s.
Yeah.
Where, for instance, another case is Solana, which pretty much only focuses about on-chain scaling. So that means that it tries to scale its own blockchain, so it tries to scale its layer 1 directly. But for the sake of Ethereum, then it is pretty much crucial, at least in the short to mid-term. So currently, Ethereum has pretty much nothing in its scalability roadmap around scaling its own layer 1.
But Mads, if we look at actual statistics on transaction levels and transaction fees, I know you track these things on a running basis. We've seen a major pickup in fees on Solana, for example.
Yes.
So what are the major trends in relation to actual transactions and the fees on the major chains here?
Yeah, so this year so far, actually, it has pretty much been centered around Ethereum. Ethereum's layer 2s, where we have seen the transaction fees also picking up, and then Solana. So Solana makes about 500,000 in daily transaction fees.
In dollars?
In dollars, yes, for sure. And then Ethereum makes somewhere between $10 million to $20 million in daily transaction fees. And some of these layer 2s, they make about the same as Solana.
Yeah. And how significant is this discussion on transaction fees relative to the underlying price development? I mean, if I'm an investor in say in Solana or in Ethereum, how important is it for me to track the actual development in fees?
Yes, we think it is absolutely crucial to follow these trends, because how we view pretty much every cryptocurrency besides Bitcoin is that they need to have some fundamentals. So we pretty much look at them like we look at different equities. So they need to have fundamentals. They need to have a cash flow. They need to also turn over a profit, sort of. And how these cryptocurrencies can turn over a profit, they can have what we could define as a cash flow, is by having high transaction fees or generating a lot in transaction fees. So that is pretty much how these blockchains, they generate revenue.
And Mads, it's no secret that we've launched a crypto portfolio here at Steno Research with you anchoring the allocation strategy. Without revealing it all, what are sort of the major trends in your current allocation strategy for the crypto portfolio? Then we can allow people to go behind our paywalls to find the actual composition. But what are the major trends in your current allocation?
Yeah, so the major trends is that we are are that we are looking at cryptocurrencies with a cash flow. So we are only like pretty much evaluating cryptocurrencies that generates transaction fees, and also by generating transaction fees, they also have a great degree of adoption. So we pretty much access the market as having an excess supply of block space, meaning that there are too many blockchains out there, too many cryptocurrencies, and the majority of those will never ever see any sort of network effect. So we only take cryptocurrencies into our portfolio if they have realized at least a pretty high degree of adoption and network effect.
Yeah. And the aim is obviously to beat Bitcoin as a benchmark in this portfolio by scaling up and down in the positioning size relative to Bitcoin.
Yes.
But do you think there will be a time where you don't have any Bitcoins in your portfolio, Mads?
Yes, maybe actually.
Yeah.
I think if we see like a pretty much full-blown 2021 bull market, I think then we will probably allocate even more capital towards some of the other layer ones and then layer twos.
Yeah.
And that will be the consequence of Bitcoin, because we think then they will outperform Bitcoin.
Yeah, and we've obviously tried to map the betas of various cryptos relative to Bitcoin. I guess the length of the data series are not particularly long so far, and that therefore the study is a bit fishy so far. But the interesting thing here is that when dollar liquidity improves, as we've seen, when the cycle improves from a macroeconomic perspective, as we talked about in this podcast today, it seems like the risk taking within the crypto space also moves out the risk curve in a sense.
Yes.
That's kind of what we're seeing at the moment, isn't it?
Yeah, exactly.
Yeah.
I think that was also what we saw in 2020. So the year before we saw at that point biggest crypto bull run is that pretty much Bitcoin starts the cycle. So the capital starts to flow towards Bitcoin, and then after a while, when the liquidity picks up, when retail returns to the market, then some of that capital flows into what we define it as altcoins. So the alternative coins to Bitcoin.
Yeah. Mads, it will be super interesting to see whether you're right in the launch date of a Ethereum spot ETF. Given the interest that we've seen in the Bitcoin spot ETF, it is kind of almost a promise for success, if you ask me.
Yes.
Once we actually get that ratification of the spot Ethereum ETF. Mads, what are the signs you're following for clues on the timing of this Ethereum ETF, and what are the expectations in the market right now around that timing?
Yeah, so we know that the SEC, the US SEC, they need to either approve, reject, or then postpone the application from a firm called Van Eck, and they need to do that by latest 23rd of May.
Okay.
So, of course, they can either reject it, which I think is very unlikely, because if they will not approve it, they will probably just postpone the decision. But I think it has been pretty clear that SEC, they also want to approve the applications, because they did, which is pretty much the biggest sign that they are willing to approve it, is that they approved the first Ethereum, but not spot-based ETF, but futures-based ETF in October last year.
Yeah.
And that is pretty much a sign that they are willing to approve the ETF, and also the fact that when they approved the Bitcoin spot ETF, they also acknowledged that market manipulation, which were like pretty much all the rejections were grounded in market manipulation, that market manipulation is just as likely to happen in the CME futures as in the spot markets, meaning that they have already approved a futures ETF, an Ethereum futures ETF based on CME futures. So they pretty much acknowledge that if market manipulation is to take place, then it will also happen in the futures market anyway. Yeah. So that's not really a reason anymore to reject it.
let's see whether you're right that we get some clarifications by the 23rd of May, if I heard you right. It will certainly be interesting to follow. Mads Eberhardt, thanks for joining us.
Thank you.
And to those of you watching or listening, please go to stenoresearch.com to check out Mads's actual allocations in the portfolio. We teased this as much as we could here, but the actual allocation is reserved for paying members of Steno Research crypto offering. Mads, good seeing you.
Thank you.
We're back in the studio from the interview with our great colleague Mads Eberhardt. And Mikkel, I have to admit, every time I talk to Mads for like 15-20 minutes, I feel like such a boomer. Lots of words I don't understand, and it kind of puzzles me how the future will look after. But I mean,
that's why we hired him.
Yeah, exactly. To become a bit wiser, and I guess the future is here in many ways. But Mikkel, let's talk about the present instead, because when we look at the European efforts to support Ukraine, they will obviously also impact the outlook for the European Central Bank, the outlook for European debt markets, and so on and so forth. Denmark took a decision to pledge support for Ukraine over the next 10 years. We also saw a decision taken in Sweden lately. But what about the rest of the European Union? I mean, we don't see the same momentum, do we?
In some parts, yes. In what we could call Central Eastern Europe, the support for Ukraine is still huge. They already ramped up their military budgets years ago and are continuing to do so.
Poland, for example.
Poland especially, the Czech Republic, the Baltic countries. What we're seeing in what we could call Western and Southern Europe is, with a few exceptions, still perhaps not moves to pledge too much support to Ukraine, but still moves toward huge rearmament packages. That's the UK, that's France, that's Germany, that's Belgium, all across the place. And much of that is, of course, through government borrowing. I mean, and not very many of these countries have the sort of fiscal surplus that we have in Scandinavia. So there's a huge rearmament wave going on in Europe. It will continue. A lot of this is related to Ukraine, yes, but it's more related to the general threat from Russia. So even if there is some solution to the Ukraine war or that, we will still see continued rearmament throughout Europe. Basically, the lesson that should have been learned either in 2014 with the annexation of Crimea or when Trump was president first, the lesson that Europe needs to take care of its own security has finally sunk in, and that costs a lot of money.
It feels kind of inappropriate to wear a T-shirt saying "milk cows, not taxpayers" when we're discussing this. Yeah. It's not on purpose. I just wear this quite often because I, to a certain extent, hate paying taxes. Never mind, Mikkel. If we look at the European Central Bank, the discussion on whether this spending on the warfare essentially will impact interest rates. We had a very, very interesting article written by Will Dudley, the former president of the New York Fed, as far as I remember, in the US. So he referred to the so-called R star, so the equilibrium interest rate in the US economy. And he discussed in this piece whether the R star was much higher than anticipated by anyone due to the almost perpetual large deficits of the United States. And I guess it's fair to say that the fiscal picture has changed quite dramatically since 2020. We've basically opened a can of worms in relation to budget deficits in the US, but also elsewhere. And I mean, even in the mother of fiscal conservatism, Germany, we now have ongoing discussions on how to get around the so-called schwarze Null policies. How can the politicians are discussing how to spend without actually breaching the covenants in the constitution. So this is something that will impact monetary policy as well. We're stuck in this weird situation with extremely easy fiscal policy and monetary policy that has to sort of pull the overall policy mix in the other direction.
Absolutely. And we're looking at not as much the US, but if you're looking at EU politically, we're looking at two crises right now that the EU is trying to solve. There's a security crisis, which is solved by buying weapons, so spending a lot of public money. There's a climate crisis, which is still, even we don't talk too much about it, it's still a very huge political subject within the EU, which is also solved by public spending for some reason.
Yeah.
And that those two crises are so important politically that it sort of supersedes all other requirements. We used to have what we call the convergence criteria, which was supposed to keep basically a German invention to keep the other Euro countries in check and EU countries in check, to not spend too much, or not to have too much government borrowing. That's basically out of the place and has been since Corona. Yeah. So now we have the solution to all these crises is government spending, and that's what we're going to get.
Yeah. If we look at a nowcast on European inflation, we obviously have the numbers upcoming from Germany, Spain, etc. this week. Our nowcast is printing at roughly 0.3% month on month for the euro area aggregate. That's not a perfect number for the European Central Bank, but if you look at the 0.3% monthly inflation in February, if we're right, relative to what happened a year ago, we're talking about major progress. Inflation in February 23 was around 0.8% across Europe. So from a base effect perspective, we'll get much closer to the 2% target for the European Central Bank. But we truly need some surprises on the low side for inflation now for the European Central Bank to become comfortable cutting interest rates. We had the Austrian member Holzmann out on Friday saying that, well, ceteris paribus, he couldn't really envisage a scenario where the European Central Bank moved ahead of the Fed. And this is one of the topics that we've discussed over and over in this podcast, because why can't the European Central Bank move ahead of the Fed? I mean, it's like it's just a decision that they've taken. No matter whether the situation warrants another stance, they're like, well, we'll have to wait for Big Brother. I get goosebumps in a negative sense when I listen to such nonsense, but it's apparently a view that is well represented within the committee. So we'll have to wait and see what happens in Washington, and then we'll take a decision from there. That's basically what they're saying. I think it's hard to cheer on such stupidity, but nevertheless, we need a very soft inflation number this week to bring an April cut back in play in Europe. We're clearly leaning towards a softer print than consensus out there. If you want access to our nowcasts and our inflation expectations, etc., then go to stenoresearch.com and find the nowcasts, etc. Mikkel, ultimately, we always promise our audience that we will discuss actionable content on how to trade all of this. And I guess given this cocktail of Russian progress in Ukraine, the need to throw more money at the problem, both in Europe but also in the US, the timing of buying bonds here on sort of a trend basis is not particularly good. With larger deficits, with some signs of inflation flaring up in the US, we've covered that over and over the past couple of weeks. Fixed income is not your bet. At least you need to be very selective on which curves to buy. Europe could be a decent buy here, but not the US, if you ask us. But what about the Chinese rate cuts, the signs of pro-cyclicality in the economy, with loads of spending coming in? Seems like the economy is actually gathering pace here in sharp contrast to what you would have expected a year ago. I guess you need to buy raw materials.
Absolutely, it's construction and production. I mean, that's going to be the big theme. It's already in the US. It's going to be in the EU as well. We're going to be building a lot of weapons. Going to be constructing a lot of solar panels and windmills, and we all know where that points to.
Yeah,
China.
Yeah, it points to China, and it points to copper. It might even point to natural gas. Yeah. The good old Widowmaker. So in full transparency, we're now long the nat gas trade, and let's see whether I need to file for a divorce in a couple of months. I guess that's kind of the ultimate downside here. But nat gas looks extremely cheap relative to the business cycle here. But we have abundance of supply right now, basically due to very warm weather in the US for most part of the winter. And then, the supply side is actually doing better than feared. But we're now clearly below break-even levels for the price of natural gas. So I guess we'll see more or less mayhem on the supply side if those levels continue. Ultimately, Mikkel, let me say that the rate cuts seen in China, it will provide some temporary relief in local Chinese assets. I still prefer to trade China by proxy due to all of the political risks surrounding owning mainland Chinese assets. So we're long Korea as a proxy Chinese bet. We're long copper as a Chinese proxy bet, because there are signs of improving sentiment in China now from abysmal levels, I have to admit. But I guess the rate of change, the sequential move, is now towards slightly more positive trends out of China. That's kind of my vibe now.
Sounds realistic. Korea would be a good bet for that. Could be other countries out there as well, but that's a safe one, actually.
Mikkel, now that we've talked about the actionable content, we need our disclaimer. And as per usual, we've hired the Italian football player Gennaro Gattuso to deliver the best disclaimer on earth now that we talk trade ideas. So our trade ideas might be...
Sometimes it may be good, sometimes it may be shit.
Thank you to Gennaro Gattuso. He's actually been laid off over the past week, as far as I remember, right?
Yeah.
And, as a coach for Marseille.
Oh yeah, that's true. That's true.
So we'll send him our condolences. And Mikkel, thanks for joining us as well.
Pleasure.
And thanks for listening or tuning in out there. Remember that you can find our free newsletter, and the link is in the description below. We'll send you a slide deck on how to trade this cyclical upswing in the global economy as a free addition to this newsletter, or else go to stenoresearch.com. We always have 14 days of free trial if you want to check out our nowcasts, our trade ideas, and our portfolios. Thank you for watching and listening, and we'll be back again next Sunday.